Let's speak to Stephen Nash, Director of Strategy and Market Development at FIIG Securities, joining us from Sydney, and Clem Chambers in London. So, Stephen, take us through what you expect from Rio Tinto. The numbers coming out in just under about 30 minutes' time.
Look, we've seen quite a decline in growth expectations for China. A lower than expected output number would probably be consistent with that. I think since March, if you look at things like the economic surprise index for China, we've seen quite a dramatic drop there. I imagine that weaker numbers would be something that would be consistent with that decline, and that's quite significant for the Australian economy, I think, as well.
Yeah, could we see further divergence between BHP and Rio Tinto in light of the fact that Rio has far more exposure to what happened in the Pilbara region?
Yeah, there's differences between these very important Australian companies, but look, I think in terms of mining outlook, we're looking at a transition in the Australian economy from that mining sector to the non-mining sector, and trying to get that growth a little bit stronger, and that's why the RBA's been doing what it's doing over the last few months, hinting at extra easings, but not really delivering as yet.
Stephen, you got to wonder, I mean, valuations in Rio Tinto, in BHP, they actually look quite compelling at this point. But again, a lot really depends on what happens to the iron ore price. Would you buy into the sector right now?
Look, I think getting a little bit overweight, given the correction we've already seen, would probably be a prudent idea at this point. However, it really depends on the extent of this slowdown in China, and whether the authorities are really going to get much more serious with regard to reining in the shadow banking sector within China. We've seen at the end of June quite a large disruption in money markets in China. That appears to be fixed at this point, but yeah. I think the main takeaway is that the Chinese are getting much more serious about constraining previous practices which really shouldn't have been there in the first place.
Yeah, that probably explains why the RBA sounded less dovish than expected in light of all these problems unraveling in China. The fact that copper isn't such a decent gauge anymore, since that is being used to finance a lot of the shadow banking loans. So do you think there could be a sharp unwinding, and that could hurt the commodity plays like Rio especially?
Look, even though these minutes were unchanged from they're a little bit unchanged from the prior, haven't got the new Chinese data in there, it does point to the fact that, things have weakened since the minutes were created. I think there might be more acknowledgement of this in the RBA's future statements. We've also got the CPI coming out, and I think that's really the important key piece of information here. If we get a core reading under 0.5, I think that could tip the scales much more in favour of an easing. We've been going for an easing for quite a while. We're expecting one more easing to complete the cycle at this point. Whether it's in August is an open question at this point.
Yeah, the swap markets were pricing at about a 60% chance of an August rate cut, but it looks like a lot of those bets being unwound. When do you think that's going to happen?
Look, I think if we get that lower than 0.5 core reading for inflation, it could be the August meeting. Prior to these minutes, we did have some quite weak data on the employment side. I think that really got the market looking for continued dovish statement by the RBA, but the RBA, as it usually does, tries to indicate that at this point policy is appropriate, but there is further scope to ease, and I think they will take advantage of that if they get a weaker than expected CPI read under 0.5.
All right, thank you so much for that, Stephen. We'll definitely be watching out for the CPI read out Australia later on this week. That was Stephen Nash of FIIG Securities.